Directly from 42nd Street in Midtown Manhattan, New York, I am your host Harbin and you're watching my channel YOLO, You Only Live Once. Welcome to a new show. Today we are going to talk about whether your financial brokerage firm can go down and what to do if that happens. In the financial turmoil, we are seeing this. We have seen this month where SVB failed and then Credit Suisse actually had problem. Can this happen to one of your brokerage firm like Charles Schwab, Fidelity, Vanguard, even Merrill, or JP Morgan Chase? So you name it, anything can happen to any brokerage firm. Nothing is set in stone. If Lehman Brothers can fall, then anything else can fall too. It's better to be safe than sorry. So let's understand what type of insurance brokerage firms have and how you can protect yourself in case your brokerage firm financially fails. So the insurance basically that protect your assets in a brokerage firm is called SIPC. So let's look at what is SIPC and what it protects. So if you go to SIPC.org, you can actually look at what SIPC protects, and it's such as stocks, bonds, which are held by a customer at a financially troubled SIPC member brokerage firm. So first thing you need to identify with your brokerage firm is whether they are member of SIPC. If they provide SIPC insurance, then you know that your stocks, bonds and cash are actually protected, and the limit of protection for SIPC is 500,000, out of which 250,000 limit for cash. But we need to understand this is the cash in the brokerage firm, which is there for the purchase of securities and not in one of the money market funds, because that will be more of a securities and not a cash. So you won't get a 250,000 cash protection for your money market account. It is the cash you might have lying with the brokerage firm before you are going to buy a stock or a bond from that money. So most customers are protected, and the understanding is that they are protected for 500,000 value, which is not correct. The 500,000 protection comes from the fact that the securities in your account on the date it fails are replaced by SIPC with equivalent securities. So that means if you have a stock, suppose you have a Google stocks and your brokerage firm, which values on the day it fails 500,000. So that means suppose at today's value of 100, you had 5,000 stock in your brokerage firm. So then you had a 500,000 worth of portfolio with your brokerage firm. But after it failed, financially failed, and then the SIPC took over, and it took couple of weeks or maybe months for you to recover that money, or they were able to there, and the stock falls to 50 during those financial tough time, the SIPC is going to only replace 5,000 Google stocks with the 5,000 Google stock in a new brokerage account with the different brokers, and not a 500,000 value of portfolio, because that 5,000 stocks of Google at that point a month from now might only values 250,000 because the Google stock price has gone down to 50. So this is what you have to remember, that the SIPC Insurance is going to replace your securities number of stocks but not the value of your portfolio. So that is a distinction over FDIC insurance, where the FDIC will replace 250,000 in the amount in the bank by a 250,000 in another bank account. But in this case, a brokerage account is only replaced with equivalent securities and bonds and not guaranteeing the value of your portfolio. So now, how to safeguard yourself in case a brokerage fails financially. So one thing you can do is what type of accounts are actually protected. The individual accounts are protected. The joint accounts are separately protected. An account for a corporation is separately protected. An account for a trust is again separately protected. An individual retirement account is separately protected, and a Roth individual retirement account is separately protected. Account held with an executor of a state, and account held by a guardian for a ward or minor. Of all of these things, okay, if you really want to basically protect your assets, the best thing to do, which I have done after the SVB collapse, is, even though like I have banked with Bank of America for almost 30 years, okay, I opened it in early 90s and now it is 2022-23. It's already 30 years I have this account with Bank of America and Merrill Edge, but still after this SVB collapse, I opened for the first time with Chase brokerage account. I had a Chase checking account for a long time because I used the JP Morgan Chase issued, it's called Turn credit card. That's my primary go-to credit card I use. Still, I never actually opened a brokerage account with JP Morgan Chase. This is the first time I actually did that, just because I would like to diversify my risk, okay, because even though if you have the protection with Merrill Edge that okay, that amount above 500,000, basically the assets will actually go to just another brokerage if Merrill any time fails, but the values, okay, can go down drastically during that time. That will take it to basically replace the securities in another brokerage account. So in order to safeguard that, it's better to actually have three types of accounts. So I have three types of account. I have a CMA account with Merrill Edge, which is the normal joint accounts, okay, and then I have an individual retirement account, and then I have a Roth account. So I can actually protect up to 1.5 million in Merrill Edge by distributing over those three accounts, and then I can have the same three accounts with JP Morgan Chase. I can have a similar three accounts with Charles Schwab and Fidelity. So that means if you look at just with 4 brokerage firms, you are able to basically distribute almost $6 million. So if you want to basically protect more, you should diversify more over multiple brokerage firms instead of actually keeping more than 500,000 with the same brokerage firm in a single type of account. Is there a chance that some of these financial companies will go down? You never know. That's the thing. You never know. No one knew that a bank like SVB, which is backed by most of the VCs in the Silicon Valley and has has been catering to more than 50% of USA's startup companies, can go down just in the matter of 2 days. The point is that transferring securities from one bank brokerage account to another brokerage account takes at least 7 days, 7 business days. And that also if it can happen electronically. Bank account, still you can actually withdraw money from one account to another. Okay, if you know SVB was going down, there are a lot of people, $42 billion were actually withdrawn on Thursday, okay, in just one single day. So there were a lot of people who were able to take their money out, but in case of a brokerage account, there is no time, because even you sell your security is actually settled in 3 business days. So you cannot actually transfer your account in single day from one brokerage firm to another brokerage firm. So if your brokerage firm is going down financially, there is no way out for you to basically switch or take your assets anywhere else. So make sure you understand that, and if you understand that, do not have more than 500,000 of securities in a single brokerage firm, okay, in a single account. If you have multiple types of account with the brokerage firm, it's good to have, okay. Otherwise, diversify. Most of the brokerage firms nowadays are same. You can buy the same type of securities with Charles Schwab, with Merrill Lynch, with JP Morgan Chase, with Fidelity or Vanguard, okay. So if you are fond of some mutual fund or something, you should basically make sure that it's easy to actually open an account nowadays and move your assets around. Keeping 100,000 more or less in an account is not an issue. If you, instead of 500,000 you have 600,000, then still is okay. But do not try to basically stash and think that okay, it is too big to fail and will not have a problem. Any bank, any brokerage firm can have problem. And Fed is not done, okay. Fed is not done, even though Fed has basically raised only by 25% this time in March of 2023, but Fed is not done if the inflation doesn't go down. Think of it, the Bank of England has just raised another percentage point because the UK inflation rate hit 10%. So the Fed is not done, the inflation is not done. If the inflation still come up rising in the next couple of months, Fed will be again aggressive on increasing Fed rates. So make sure that you safeguard yourself, okay. There's no harm in basically having multiple accounts with multiple brokerage firms. What's wrong in that? There's nothing to worry about. Basically nowadays it is electronics, okay. You can actually have the accounts online and maintain it online. You don't have to worry about it. You have one principal checking account for your daily expenses, and then you link all these accounts to that particular checking account, so that if you sell your security in any of the brokerage firm, you get your money transferred to the same checking account that you use. So it's not necessarily that okay, if you have accounts with multiple brokerage firm, you have to have checking account with those banks or those things and then you have to use them, okay. That's not the point. You can actually only use one checking account. Like I always only use Bank of America, and I have all my brokerage account, whether it's Charles Schwab, whether it's Fidelity, whether it's Merrill Edge, whether it's JP Morgan Chase. They are all connected or linked to my Bank of America checking account, and then I basically transfer the money to that account and whenever I'm purchasing or selling securities. I hope you understand that. Make sure you take this action sooner than later. Don't wait for something to happen, because as you can see, it's not cash. Okay, bank accounts are easy to withdraw money from. Okay, you can actually have a wire going same day, but brokerage accounts are not easy to transfer. If Charles Schwab today have issues, there is no way I can take my securities out of Charles Schwab and move them to Merrill Edge. I'll have to go down with that ship. I'll have to incur the loss if I keep more than 500,000 in one account. So you need to understand that, and then make sure that you are covered. Okay, you don't expose yourself to unnecessary risk. So first rule of retirement planning is that in retirement you don't want to take extra stress. I have seen people who have suffered with SVB, and 4 days of that stress is not something you would like to take during your retirement years. You don't want to basically scramble for what happened to your account, whether you'll get your money back or how much you will get back. And so you should not be dependent on one. So as the saying goes, don't put all your egg in one basket. So don't basically have just one brokerage account. I hope you like this topic. If you like the topic, please subscribe to my channel and like the video, leave a comment,